Hi, well, my name's Craig. I'm one of the full-time MBA students, and we've just been asked to do about 4 sessions on your finance. Finance, basically like finance tutorials. You guys are working through towards your midterm. So Mark's going to cover the first 2 sessions, and I'm going to look at risk and return and then whack with you. Maybe just a little disclaimer before we start. I don't see the purpose of this really to give you all the knowledge you need. I really want to go through the notes, but then I'd expect that you still have some studying you need to do in your own time. So today the objectives of what we're going to cover in this session, we're going to try and get through, just look at portfolio theory, and I'm going to speak a little bit more about the efficient frontier, just to provide a background. Then we're going to speak about systematic and unsystematic risk. We're going to speak about how you measure the systematic side of that, and then we can speak a little about the betas, so your equity betas, and how you lever and unlever those. If this is all sounding French, we'll hopefully make it clear. And then we're going to speak a little bit about something called the pure play beta approach, and that's one way that you can actually calculate a beta. So that's what we aim to cover, and this session is going to be maybe more theory than the session on WAC. And WAC is definitely more important, but this would provide a good backdrop if you are interested in finance. So I think these are the session notes he had, and instead of just starting on the return, what I'm going to do is we're going to just start on the we're going to start on this slide. And I just wanted to explain what this is called, the efficient frontier, and modern portfolio theory, which is Markowitz and the boys. They speak a lot about how do 2 assets interact. So if you have a portfolio of assets, how do you know which asset's actually going to be better? Which combination of assets? And there's 2 key words with this. It's risk and return. And the whole idea is that if I have an expected return and risk, there's a relationship saying that the higher my expected return, the higher the risk. So an asset up there, for example, would have really high return and risk. And an asset down here would have lower risk, but also as a result of the lower risk would have a lower return. So what basically the efficient frontier does is it maximizes your risk-return relationship. And what you'll see on these notes is they highlight a couple of key points, A, C, and D. So let's just bring this around. So remember, we're thinking risk-return, risk-return. If we just compare points A and D, what you'll notice is point A has an equivalent risk to point D, but the important thing to note is that A's return is a lot lower. So if logically, which asset would you prefer to have? One that had volatility of say 15% but gave you a 5% return, or one that had a volatility of 15% but gave you a 20% return? It's pretty simple. So D would be a preferred point. So what you'll start to notice is all these points on the top portion of the line have a preference to any points on the bottom of the line. And so this top portion actually forms your efficient frontier. All of these points below will be suboptimal positions. Point C is the point that has the lowest risk for that asset. So how the argument goes from here, and what you would have seen is maybe this would be this slide in your lecture notes. And what I just wanted to do is to spend a first little while explaining and giving you the broader picture on how we get to this. And so we see that they had these assets, and we're going to add this line in now. What this theory basically looks at is it says, well, what happens when we combine a risky asset with a risk-free asset? And how does that relationship play out? And so what we can see is this line generally must intersect at the tangent on the efficient frontier. What this line basically says is how does a risk-free asset and a risky asset interact? Okay, that clear? So then what you'll notice is that where there's zero risk, so in other words where it intersects, you'll see that is equal to the risk-free rate. And that's going to come into our discussions about WACC, but I just want to give you the background to it. So that's your risk-free rate. You see how where it intersects the axis? And portfolio D will be what we call 100% in the risky asset. So this is just assuming that I invested all my cash into the risky asset. And all the points along here will be combinations. So basically saying, here I'd probably invest 80% in a risky asset and 20% in a risk-free asset. And over here I may invest 20% in the risky asset and 80% in the risk-free asset. And so this is what the portfolio theory is trying to measure. So they've given you a couple of formulas to measure that, but it hasn't actually made up a large part of our course. So I'll go through it very briefly, but I just wanted to, it's quite important to understand at least the background to this, because it lays a nice platform going forward. One thing to note is what happens in the line when you go past point D. I mean, this is, okay, we've said that this is 100% in the risky asset. This is actually a point where you start borrowing money. So you start borrowing at the risk-free rate and investing. So you actually start investing more than 100% in the risky asset. Some may see as this is when you start to gear a portfolio. So say along here you'll be investing 110% in the risk-free asset. Sorry. And so on. And then here is where you effectively are investing a combination of the two. So I hope that's clear. That provides a good background to where we're going to go. And what we need to speak about then, so now if this provides a backdrop to what we're going to talk about, these two concepts we need to understand a little bit more in depth. So we've got risk and we've got return. So if we look at the risk portion, yeah. Okay, you've got a graph that looks a little bit like this, and we're just going to flip back to it. So now we're going to, okay, so let's see, if you just look at this diversification slide, sorry, hopefully this will start to make more sense. Because what we're basically trying to do now is we're saying, well, what is this actual risk that we need to measure? And what is common in finance is this whole concept of diversification. That once you start to add more assets to a portfolio, what you'll notice is that diversifiable risk, otherwise known as the unsystematic risk, gets less. How this happens, because if I have two assets and bring up space here. If one asset's return does this, and the other asset's return kind of bounces around. If I combine these in equal weights in a portfolio, when one asset's going down, the other one's going up, what you'll notice is it tends to make it less volatile. It makes the investment less risky. So what this graph is basically trying to say is, as we add, you'll see on the x-axis, you see as you add assets into a portfolio, the diversifiable risk decreases. And in South Africa, on the JSE, you'll notice it tends to be about, they say, between 30 and 40 stocks that you should hold to remove to remove as much diversifiable risk as you can. And so what you're left with is you're left with risk that you can't diversify. And that's called the systematic risk. And the systematic risk is what we're actually going to focus on, because that's going to lead into what we call the beta. So let's just go through the slides so I don't leave you behind. Because this is what I was speaking about earlier, just in the way assets move with each other or against each other. You'll notice that the first one, So assets are moving in the same direction today, or same direction. You'll see that the risk will still be high on those. When they start moving in opposite directions to each other, you'll notice that the risk decreases. So then they came up with measurements for these risk-return relationships. And again, while I say it's good to know, like, I understand your time's limited. And again, so write the formulas down, try and understand the bigger picture of what you're actually trying to do. But know that this is probably not likely to make up a big part of your test. The expected return is simply saying that if I have and I'm just going to use my mouse here. If I have an asset, one asset that gives me 10% return and another asset that gives me 15% return, what I need to do to find the return of my portfolio is I need to look at the weights that I'm going to be investing in the first asset and the weight that I'm going to be investing in the second asset. The combination of two will provide my expected return on the portfolio. Okay? It should be really simple. I'm just going to quickly do so. I wasn't going to spend too much time on this, but let's just do one example. So if I have asset 1 that has an expected return of 20% and its weighting is, say, 50%. And then I have a second asset that's got 10% and that's going to be weighted 50%. All the expected return of the portfolio will be is my weighting times the return. And you can do the maths for yourself. But that's, what we're going to see is it's the same works with a risk-free asset. If you're going to invest in a risk-free asset and a risky asset, it's the same thing. I'm going to invest 20% of my portfolio in a risk-free asset. And then 80% in a risky asset, you'll do a similar kind of calculation to this. And the portfolio variance, and this is how does a portfolio fluctuate around its mean. Again, they give you a formula, and the whole idea is that you calculate the standard deviation, and from that you'll see it leads into your volatility. You can just keep it on the screen, it's fine. So, and again, the volatility is how much does this portfolio move? How much does when I look at the returns, how much risk am I actually going to be taking for that level of return? And the formula is given. I mean, even for the 4 assets. I mean, don't get too caught up in this. It's a repetitive formula. Just write it down, and if you get a question, it is quite easy to work out. And that's how we get back to the efficient frontier. So I've used that as just a backdrop to provide this understanding, and just remember, we speak about risk and return in this section. So how do we then look at 2 portfolios? If we take this relationship that we had, and we say, well, now we're just going to look at the systematic risk. So we're going to say we've got beta and we've got our expected return. So what happens if we look at a bond portfolio that has a profile like this? We invest here at this level of risk. What would another line tell us? The second line, and this is quite interesting, is because if I'm comparing portfolios, so now I'm given 3 options, 3 different portfolios, and I want to compare the return to see which one am I going to get the greatest return for the level of risk. then conceptually we'd look at it in a similar way to this, where you'd be looking at almost the lines. But what you're trying to do is you're trying to say, well, how do I calculate this point? And what you'll notice is that what happens if one of these portfolios, so when they gave me a document, and this is for an investment, they give me a document and they say, well, Craig, I'm going to give you this risk of 10% and the return is, say, 15%. And this one here, the risk is 12%, but this is probably going to be about, this is an easy one. What you'll notice is that, although this is quite obvious, when you've got different risk-return relationships, if you plot it on the line, and you take the slope of the lines, this gives you your risk-reward ratio. So what happens if you find that for each portfolio that you get, you effectively are going to be able to see which is the greatest slope, and that will be the portfolio that's going to give you the greatest risk-return relationship. And another way to just talk about this is to call it the Sharpe ratio. And that's all the Sharpe ratio does. If we just focus on the screen for a sec. So you're just looking, you're taking the expected return of your asset less the risk-free divided by the risk. And what you see is it gives a figure that is more comparable between two portfolios. Okay, so we have moved through some of this quite quickly. And I just want to stop and just go back to this, or just maybe spend a bit more time talking about CAPM, which we're going to speak about a lot more going forward, because it's one of the ways that you measure your cost of equity. And there's just there are some examples. I'm going to try not to repeat everything they've talked about here, but I'm going to try and just clarify the bigger picture for you on a lot of the concepts. So we're working towards that CAPM. Let's just quickly look at this slide about beta. So we know that this systematic, we've spoken about the systematic risk portion now that we're trying to understand more. And what we need to understand is that, well, how would you calculate this beta? And to calculate that systematic risk, one of the most common ways is actually just to regress the return on a share with the return on the market. And this slide is given to you. It's just quite simply, you're looking at the slope of that regression. And where it says in the bottom, if I have a risk in the market, and my beta that I calculate is greater than 1, it should then make more sense that the portfolio you're speaking about is riskier than the overall market. And if my beta of my portfolio is less than 1, then obviously the overall market has got a riskier portfolio. And if I had to, we're going to bring context to this when we do it in a whack. So if it is seeming a little bit strange at the moment, just hang in there. I'm not going to speak about that. Again, these slides you're given, but the levering and unlevering becomes more of an important part later in your course. I'm going to go through it now, but I want you to understand that the beta, this slide that you've got here on the levering and unlevering betas, like we use it quite a lot in our final exam and in valuing businesses, but for this, maybe for the midterm, it's not going to be as important. So what we are saying is, if I've got a company that I'm trying to value, and I can't calculate that beta, in other words, it's very difficult for me to understand what the risk of the market is. What I can do is I can try and find comparable companies that have got betas that I can identify with. And this is called a pure play beta approach. What you're effectively saying is that if I can get a couple of companies, and we're going to use one example that just uses 2 companies, all I'm going to do is I'm going to take their betas and I'm going to try and make them effective for my company. So I'm going to take the risk of that company and I'm going to try and what they call lever and unlever it so that it's relevant for my company. And I want to do that so that I can, and you're going to see when we do the WACC, so that I can calculate a cost of equity and I can understand the risk of my company. I think we are speaking more about companies now, and just understand that maybe we've shifted a little bit from speaking about a portfolio of assets, which is risks, to now talking about a company risks. And so we're departing from the portfolio theory in a sense, but some of the similar principles will apply. It's still looking at risk and return. So, see, actually this example I'm going to share with you is one that we actually do as our last example, or last assignment in the course, funny enough. And what happened was there was a company that was looking, it was a chemical company, so he's looking to buy a chemical company. And they're trying to determine the beta for that chemical company. So what they have to do is they decided to do what they call a pure play approach. And there were 2 competitors, Brunswick and Southern Chemicals. And the whole logic here is to say that while Brunswick and Southern do have betas that we could use, each of them has a very different capital structure. So they're made up of different amounts of debt, equity, which means the risk. Again, we're speaking about the risks. The risks of the company are different. So what we want to try and do is we want to take out all the risks that are relevant to that company and still get what they call the asset beta. So what we are assuming is that the risk of the assets, because they're in a similar business to me, the risk of the assets will be the same as the risk of my assets. So what we're just trying to isolate is that risk. And then we're going to apply our capital structure to make what we call an equity beta. So this is the beta of the firm. So when you, can I just go back to the slide for a sec? So I know this may sound a bit strange and you may not have covered it in this depth, but if I give you one example, but it may help contextualize where we're going. So you can see this formula up here. And that's basically what it's saying, is if I identify the assets, the beta of just the assets of a comparable company, and then what I do is I add my capital structure or my debt and equity ratio to that, what I can do is then I can calculate the beta for my firm, otherwise known as the beta of the equity. So that's the risk that I'm facing there. That's why this line here will make sense. You know, it says that the beta of the equity is equal to the assets in a firm without debt, because you only have equity in your capital structure. Capital structure, if that's sounding like a confusing word, it's just a way that you blend in equity and debt when you buy things. And it's, again, we're going to start off the WACC lecture with that, but it's a combination of equity and debt, and those both have different risks. So let's just look at an example, and we'll go through it step by step. So what we were given is we were given an equity beta for each of the comparative companies, and that's recorded over here. So one was 1,1 and the other was 1,2. What we then do is we say, well, what is their capital structure? And for this, we like, it's quite important to use the market values. Is the debt equity ratio, and we identify the debt equity ratio as just over 8% and 13.7%. The tax rate's given at 48%. So then we say, well, how do we calculate this formula? So how do we unlever? This is the first process what we do. So you've identified the companies, now we're going to say, how do we unlever the beta? To do that, there's 2 formulas, and I've actually just written them down here. So all you've got to remember for this, and again, if you really are stressed for this midterm, maybe watch this at a later stage, but because it's been in these notes, I'm just covering it now so that it makes sense for you later on. There's two formulas. What you've got to understand with the company, and you can remember with finance, sometimes you won't have all the information you need. Sometimes you need to write an assumption, and always remember one thing when you write the assumption. You must write the reason, you must write the assumption and the reason for the assumption. A lot of guys battle because they write an assumption in their exam saying that, well, I've used this return, or I've made this assumption, and they haven't justified it, and they didn't go too well. So back to here. So we've got a stable debt ratio and an unstable debt, and remember this is just used to calculate the beta of the to unlever it. So you can see. In this example, the debt ratios were stable. So what we could use is we could use this first formula over there. And when we do that, very simply, now what we've done is we've isolated the risk that just relates to those companies' assets. So then all we have to do is to do a weighting of that. So we take the total value of each firm, and then we say, well, what is the weighted beta? So this figure here, 1.0, becomes our weighted beta, and this is just of the assets. So what we've effectively done, just to say, we started off with the risk of the entire firm, the comparable companies. This is a pure play approach we're talking about. And then we've said, well, let's isolate the risk on the assets, because our assets are going to be similar to theirs, and this is what we've effectively done. We've identified the risk related to the assets. Now what we want to do is the next step is to calculate the debt ratio that relates to our company. This is a target debt ratio, and you're saying often it's given, but you may need to calculate this. Again, for now, try and conceptually understand it. I don't think you need to go into that depth. So we're just assuming this is given at 35%. That's the kind of debt ratio that they want to have for this is for our company. The next step then is to say, well, now we know what the risk of our assets are and we know what our capital structure is. We then need to try and incorporate our capital structure and the risk of the assets. And this is the process they call re-levering your beta. So our company in this example is called Dixon. And what we do is we start with the beta of the assets of the comparable companies. What we do then is we've been given our debt equity ratio. Sorry, this is just the debt ratio here. That was 35%. So the debt equity ratio works out to be 53.85%. Tax rate's the same. And all we do, and in this example, I mean, this was one mistake that was made, is this was actually using the stable debt ratio of the company. So when I'd done this example, I'd assumed, well, Dixon also has a stable debt ratio. But in this case, Dixon was not actually stable. And so what I should have done is just used Formula 2, which says, well, the debt ratio, that's this DO, or D over total value, was unstable for Dixon. And as a result, I simply use this formula to calculate my equity beta. You know, you'll have to rearrange it. This is all set in terms of the asset beta.